Now, yields at Nigeria's fixed income market are expected to advance, particularly on the medium to long-term instruments, as investors continue to anticipate higher returns and sell-offs persist. That's according to traders at UBA. And I have Dumebi Udegbunam. He's a fixed income trader at UBA. He joins us now to tell us more. Thank you so much for your time on the show, Dumebi. Let's first look at what you were saying there, talking about investors anticipating higher returns as sell-offs persist. Can you paint that picture clear?
Okay, good afternoon, Kenneth. Thanks for having me. So, as we've seen in the market, we've seen sell pressure as we had a sell debit yesterday about industry figure of about 5 billion was debited. So that more or less still sports some bullish sentiment. However, we saw a bit of bullish sentiment here and there because the system is a bit liquid compared to where we're coming from in the last trading week of May where we're in a negative. And I think throughout the month of May, system liquidity was in the negative. So we saw intermittent buys here and there, but the view or the atmosphere in the market is very sentiment that people still sell to fund liquidity pressures as we're facing the market.
All right, but what about the secondary market? How do you expect things to pan out there?
And well, we are still seeing when for the bond side of the market, we're seeing should I use the word panic buys today in the market? We saw a bit of panic buys in the market. As we all know, there's a maturity coming in. There's a 2021 maturity bond coming in July. There's no coupon payment in this June, but there's a maturity coming in July, and also there's about 460 billion in coupon payments also coming in July too. So people are buying on the back of that, and they are foreseeing maybe there might probably be a taper in yields. However, the view is still an upward trend in yields, as we saw in the last auction and in this next auction we're going to have in June. There's an anomaly also. So the auction before, in the May auction, there was the 20 there was 2049 that was offered. In the auction in June was in 2050 being offered too, which is different from what we're seeing back then. We are seeing the regular maturity 2027, 35 and 45. Right now we're seeing an anomaly. In the last auction we had 49 replacing the 45. In this auction now we're having 50 replacing the 49 also too. So all these different indicators in the market have caused a bit of panic. So people buying discovered their short positions on the 49 bonds they had or the previous bonds. However, the view is still an upward trend in yields going forward.
All right, what's also driving sentiment in the Tertiary bill space, especially the appetite for special bills?
Also, we had the special bills mature. However, there's a bit of a roll. However, we are just informed that they've been a rollover. So for industry figures, about 5 trillion that matured in those bills. We had the rollover of about that amount plus a bit more that has been rolled over already. So that also has further spurred more bearish sentiment still in the market.
But I'd like to get what your outlook for liquidity is going to be for the rest of the week.
So for the liquidity for the month of June, which is the last month for Q2, which is the last month for Q2, liquidity is going to be a bit tight. So if you look at maturity, if you look at what I said earlier, there is no coupon payments in the month of June. In terms of maturing bills compared to last month we had about 460 billion bills that matured in May. For this month, we have only about 248 billion maturing in June. So that alone, that's half of what we saw maturing in May. And we know how tight the month of May was. So imagine having that half of that amount being maturing in the system. So we expect to see a tight system liquidity in the month of June.
But how do you expect the bond auction for this month to compare with that of May?
So in the auctions for this month in June, we expect to see rates higher. From the last auction, the longest end closed at 14.2. Apart from the panic we had today, we saw rates go as high as 14 half levels right now in the market. So we expect that same trajectory to follow in the auction in the month of July. However, you still know we have a funding gap, a deficit, I beg your pardon, in the budget that needs to be funded. As we know that we have a revenue crisis and a revenue problem in our budget, so that needs to be funded too. So, and that's why you've noticed the DMO is probably borrowing longer end tenor bonds compared to where they were in the Q1 of their auction issuance calendar. So we expect higher rates right now to make our bonds attractive among emerging markets. We've noticed there's been a tremendous drop in FPI inflows in the market, about 60% drop year to date in FPI inflows. So we have to make our bonds attractive compared to our emerging market peers. So we foresee higher rates in the next auction and further auctions to come.
Right, but looking at the currency, what has been the impact of the CBN's decision to benchmark all transactions to the NAFEX rate?
Well, we've seen should I use the word, a gradual convergence between the parallel and the market. So the parallel market right now has moved slightly to 410. The INE window is trading around 4. The parallel market pattern is about 485 right now. The NFX rate is about 410. So we are gradually moving to what they want. We're gradually moving to what they wanted, which is the convergence in rates. Gradually moving there. But however, the effect of what we've seen right now is rates are on an upward trend. But good kudos to the CBN as they keep on intervening in the INE window. Compared to where we were the beginning of the year, we've seen a tremendous impact in them trying to fulfill the FX obligations we have in the market. So we expect to still see that. And owing from the rise in oil prices, year to date, oil prices have moved to $70 a barrel compared to where we're coming from 59.9 in January. Right now, we're about 70.0, if I'm correct, in oil prices. So that would also help cushion us against the foreign the long hold we have in the foreign FX obligations we have in the market. So what they have done is more or less a gradual unification, moving towards a unified rate. We might take time, but this is a one step further to that.